afternoon and welcome to Adelaide Capital's webinar with Surge Energy to discuss their Q4 and year-end results. Surge trades under the ticker symbol SGY on the TSC and ZPTAF on the OTC. The company has had a record year, paying down debt, reinstating and increasing the dividend to 48 cents per share per year, a fantastic low decline acquisition of 3,850 BOEs a day from Enerplus, and a new Frobisher discovery at Stillman. In addition to that, their P plus P NAV came in at 22.37, and their PDP NAV doubling, increasing from 351 to 728, proving the strength of their asset base with a 24% free cash flow yield. With us today from the company are Paul Colburn, CEO, and Jared Duke, CFO. Hi, guys. Nice to see you again.
Thanks for having us.
I'm going to turn it over to you to discuss any more highlights you want to touch on the quarter and on the year-end results as well. There'll be time for Q&A, so if the audience wants to enter those in the Q&A question box, that would be great. And as always, the presentation may contain forward-looking statements.
Thanks, Jess. Appreciate the invite. And we have a new presentation. I'm Paul. This is Jared. Our presentation highlights our Q4 results last night, which I think are proving to be industry leading. Basically, you guys know the movie The Matrix. And the whole movie goes on, and at the end of the movie, Keanu Reeves goes, "Oh, it's a realization. I'm the one. He's the one." And there is going to be one top performer in the country for oil amongst the oily divcos in Canada, companies that are oil-based production with dividends. Last year, it was a company called Surge Energy. Our TSR, total return, shareholder return, is up 112%. And that's both share price plus dividend. But I believe we're better positioned this year to be the top performer in the country, and we'll show you why. First point here is key. This is the market has become a risk-adjusted, don't let me down, don't want to be wrong market. So everything's trading on PDP. I think Surge just put out last night the best PDP NAV per share growth of any oil company in our divco peer group in Canada. The best. Think of any other business. Think of Adelaide Capital's business, Jess and Deb. Your cash flow just went from 100.4 million in a year to 293.6 million. And we had a $98 million hedge loss. It really would have been close to 400 million. And the Enerplus deal is not in there. The Enerplus deal closed, so a 4,000 barrel a day, beautiful long life core area acquisition. It closed on December 19th. So in those cash flow numbers and production numbers, the Enerplus deal is not in there. And really a big one for us, in addition to the beautiful accretion on that deal, which is 15% accretion, which shows up in 2023, as we closed late last year, is a big new discovery we had, light oil discovery down in Stillman, Saskatchewan. We had a pool, and there's been a big discovery on the southwest corner of the pool where we locked up all the land, and we've been drilling a number of the best wells in Saskatchewan. Jared, over to you.
Yeah, so in addition to putting out some of those great numbers as it relates to 2022, we also updated our 2022 year-end reserves, had some fabulous growth here. We've seen a significant increase in our PDP up to nearly 45 million barrels of proved developed producing reserves. And so really, what does that mean for Surge and its shareholders and investors? It really shows the backbone to our company. You can see here in the first column on the right side, the left column shows that the proved developed producing reserves are worth $7.28 a share. That just means take existing production, turn off the lights, no value for Paul, myself, the management team here, simply produce out the wells that exist. That's $7.28 a share. We're trading it to about $9.40 today. So pretty much a PDP number there. Well, then let's book just a couple of years of drilling inventory. That's the proved case. Well, that's worth nearly $14 a share, $13.72 a share. And then if we take just about 490 of our nearly 1,100 drilling locations we have to go after in Surge, just take 490 of those, not the 1,100. What are those worth? Well, you put those in with the proved developed producing reserves that exist. Surge's worth, as Jessica opened, over $22 a share, $22.37 a share, based on our independently audited Sproul NAV. This is a process that's done externally. It takes several months. We start in September, many rounds with the external engineers. So we're really pleased to be able to present these independently evaluated numbers. From Surge's perspective here, our corporate guidance for 2023 continues to focus on maximizing our free cash flow generation and providing that to our shareholders. In concert with that acquisition, as Paul mentioned, nearly 15% free cash flow per share accretion. We increased the dividend nearly 15%, up 14% from 42 cents a share per year to 48 cents now. We're 25,000 barrels a day, and because we have that low corporate decline of 23%, it only takes us $175 million to maintain that production base for the year. But we're going to generate $335 million of cash flow off that production. So when you take out the $175 million of capital, it means we've got $160 million of free cash available for our shareholders, for the corporation this year. The dividend only represents about $45 million of that. So there's an incredible amount of free cash flow in here that we're continuing to put towards the balance sheet for a few more quarters and really pay our bank debt down to zero. What are we going to do in short order here? A couple quarters later, when we reach phase 2, get our net debt to $250 million. Well, we're going to double the distribution bucket for our shareholders from 25%, which is what the base dividend represents as a percentage of our free cash flow, to 50%. That's going to come out in things like increases to that base dividend, just like what we announced with the Enerplus deal. The potential for share buybacks. You can see Surge back in the market with an NCIB, a normal course issuer bid, buying back our shares when there's times of dislocation in the market, particularly being there defending the share price. And then there's also the potential for special and variable dividends as commodity prices improve. Ultimately targeting $175 million of net debt as we get towards our core terminal debt levels early next year in phase 3. It probably is worth noting here again that Surge is in the enviable position of having $1.4 billion in tax pools. What that means here in Canada is that we can shelter all of the great cash flows and free cash flows I just talked about from tax, cash tax, for another 4+ years at current pricing. So we can really distribute a very tax efficient amount of free cash into our shareholders' hands over the coming years.
Yeah, that's this is it. I've done it 4 times with 4 of the most successful oil companies in Canada, and I'm just a lawyer, so I can tell you how simple this is, but it's difficult. So it's simple to say, but difficult to get your hands on the kind of assets that we talk about here. What's our advantage? Why is Surge the top performer and probably got a good chance to be the top performer in 2023 again? I'd love to say it's Jared and I. It's elite, conventional, large oil in place, shallow, low-cost assets at water flood, while they outperform deep, expensive, tight rock. That's it. So you'll see the Enerplus deal we just did. We chased those assets 7 years. They're beautiful, long-life water floods that don't decline. What do they deliver? Free cash flow. We'll go ahead a couple slides. So, as Jared showed you, there's 2 ways we know to value an oil company: net asset value. Ours is $22.47 a share, and that's putting only less than half of the locations we have in inventory are in our engineering report. The other way is free cash flow yield. Surge is one of the top free cash flow yields in the country, around 22, 24% free cash flow yield. One of the best in Canada. The macro is, I'm going to change this slide soon. Investment imbalance sounds kind of, oh yeah, no big deal. That's going to say at the top soon, today. Massive oil supply shortage. And it might say massive worldwide oil supply shortage. The data is irrefutable. Crude, you see some of the top firms in Canada. Jeff Curry earlier in the week reiterated his call for $100 oil this year. Well, it's already almost mid-March, so that's only 9 months away. We agree. Raymond James is calling for $120 oil before the end of the year. We agree. So all I'm saying is we've gone 8 years of massive underinvestment, spending $400 billion when we used to spend $750 billion US a year as an industry. We've used up the strategic reserve. There is no excess oil under the ground in OPEC. And the exciting thing is, crude surge is 87% light and medium gravity crude oil. We have no heavy oil and very little gas. What does well in inflationary and stagflationary times, high interest rates and high inflation? Oil. I changed the word at the top here. I know it's on someone's slide, IEA or no, National Bank, but natural gas looks murky in Canada. I love it longer term, but right now it looks like it's going to below $1 this summer again. Oil looks ridiculous. It looks like we have a worldwide shortage. I bragged about our asset quality. It's our secret sauce. It's our Colonel Sanders recipe. We have it, and a lot of other people don't have it. And it makes sense. Elite quality assets drive top financial results. This chart along the bottom there is permeability, tightness of rock to the left, deep, expensive, tight rock with huge fracs needed and huge declines that doesn't water flood. Well, why do I want those? With surge, you get shallow conventional reservoirs, low cost drilling, low declines, and assets water flood. Well, look at the profit to investment ratio. PIR goes through the roof. The internal rate of return goes through the roof. And that's what Jared and I can point to. Neither of us are an engineer or geologist. We can point to the asset quality as the real reason for surge's outperformance. This is a great slide. And empirically, we created it. Jared's going to try and say empirically what I just told you with that other slide. Jared?
Yeah, so a lot of numbers on this slide. So really what I would point you to is the bottom row, which is the grand sum of the OOIP, that's original oil in place, meaning oil under the ground under surge's control. After that Enerplus deal, as we spoke about in the past, we have over 3 billion barrels of net original oil in place under our control. Well, to date, we've only taken 7.7% of that out of the ground. Well, the big prize here, as Paul spoke of, when you get these large OIP pools and you go after them in this conventional rock, you get more and more oil out. Well, what can you expect? Many of these conventional reservoirs under primary, meaning just going in and drilling a well, you can get upwards of 20% of that OIP out of the ground. Then we go in and do things like water flood. In areas like the Sparky, we've had fabulous success water flooding. We have analog reservoirs that have seen 30, 35% of the original oil in place produced out. So there's a huge prize here, going from 7.7% pulled out of the ground to date to upwards of 30 on water flood. But let's step back and think about just a 1% change. So if we go from the 7.7% we've pulled out to date to 8.7%. Simple math, that's 30 million more barrels out of the ground with a $40 net back on those barrels. That would be at a lower price, a little conservative today, but that's about $1.2 billion of undiscounted cash flow. That's equal to Surge's enterprise value today. A 1% change in the recovery factor is the entire value of Surge today. So there's a huge prize for getting just small changes in those recovery factors. So how are we doing that? Well, we're going after 2 of the top 4 plays in Canada, and we're spending nearly all of our capital here. Southeast Saskatchewan and Sparky, we'll show you how those rank here in a moment. Those are seeing over 90% of our capital this year, and we'll average about 75% of our production from those areas this year, exiting this year at over 80% of our production from Southeast Saskatchewan and Sparky. So why are we so focused there? Well, you can see here some new recent research from Peters & Co. that came out a few weeks ago, continues to, as we presented in the past, off Raymond James research, National Bank research, continues to highlight Surge's plays as some of the best in Canada. You can see here that our Frobisher wells, which is Southeast Saskatchewan, and the general conventional Southeast Saskatchewan are in the top 2 or 3 plays. Rounding out the top 4 is Surge's Sparky. So we have exposure, and not only exposure, but dominant operational positions in 2 of the top 4 plays in Canada. So the other 2, of course, are the Clearwater and the Charlie Lake you may have heard of. But Surge has 75% of our drilling inventory of those near 1,100 locations. 75% of those are sitting in the Sparky and Southeast Saskatchewan.
So the Sparky play 8 years ago was 1,000 barrels a day for us. Today it's tickling 11,000 barrels. It's a dominant position. You see Edmonton to the north there, Calgary to the south, Highway 2 connecting them north-south. So from Edmonton southeasterly to the Saskatchewan border, you have a 11 billion barrel play trend. We found out 8 years ago there's 4 billion barrels in the medium and light window. So that chart that we showed you, it says heavy oil. Ours is not heavy. Ours is about 25 API average, so it's definitely medium gravity crude, and it gets a premium to WCS heavy differentials or pricing. So we've had a field day in here over the last 8 years, drilled 200, and this will be changed soon too, 235 good wells in a row, grown it from 1,000 to 8,000, shallow conventional reservoirs. Of the 4 billion barrels in the medium and light window of the Sparky, Surge now controls 1 billion barrels of that. 1 billion. We control it. It's ours. So we see 480 more locations. We think we can grow this to 15 to 20,000 barrels over the next 5 years. This chart will change as well. We say conventional heavy oil. No, it's going to say conventional medium gravity oil. And it's thrilling for us because we have very limited competition. Wells pay out twice in the first 2 years, and then we water flood them, and we get not 120,000 barrels on primary. We get 400,000 barrels per well under water flood for Sparky now with Sproul.
Our second top area here is Southeast Saskatchewan. We got back in here in late 2021 with 2 accretive acquisitions, and we've really had some great success here organically, particularly as Paul highlighted on the opener, the Steelman area with a couple of great land sales there. We've added upwards of 60 locations to go after in aggregate down there. And what does that mean? Well, we acquired those lands and we drilled them immediately. And what do you see here? Well, from Peters and Co., they've listed the 6 wells we've drilled in there that were on production last year in 2022 were all some of the top wells in the entire province of Saskatchewan for all of 2022. So we are drilling the best wells in Saskatchewan. But what does that mean? It means we're drilling wells that are coming on here, as you can see, north of 400 barrels a day IP30. And these wells critically are paying out, meaning getting all of our $1.2 million drill cost back in net back from those wells in 8 to 9 weeks. So these wells are paying out in the matter of a couple months. These are fantastic economics, top decile for the country and the continent, really, indeed. Some of the best payouts you'll see, and we've got a huge inventory to go after in Southeast Saskatchewan of wells like this, 275 locations to go after. We now have a dominant operating position in here. We have 8,000 barrels a day coming out of the broader operating area. And we've got 1 rig dedicated to this area year round. So we've got cost certainty and rig availability nailed down. Just to close out my component here on ESG, continue to be committed to being a leader here and doing a better job talking about some of the good stuff we're doing here. We recently put out our 2nd annual ESG report here in December. It's on our website. I'd encourage you to take a look at it. If it's of interest to you, really looking for projects that are win-win. Things like our gas conservation project in Southwest Saskatchewan, put in a pipeline there, spent a grand total of $12 million. We're now producing a bunch of gas that was flared. It's highly economic for us, but it also conserves over 33,000 tons of CO2 a year. So Surge continues to be focused on abandonments, meaning reclaiming and returning wells to a natural state, doing that at about a 200% rate, meaning abandoning 2 wells for every 1 well that we drilled last year. So continue to focus here and would encourage you to look at that ESG report.
I guess last slide here. I get up in the morning and I want to be the top performer in the country. I've already been the CEO of oil companies, 4 of them, 4 of the most successful ones with 4 different teams. I don't want to be the CEO of an oil company. I want to be the CEO of the #1 performing public oil divco in Canada, and last year Surge was. This year, we already look strong, and going into this year, especially with the accretion from the Enerplus deal showing up in 2023, 15% accretive to free cash flow per share. But go back to that asset quality. Why are all these analysts picking Surge as their #1 pick or a top pick in all of Canada for oil? Why? There's 11 of the top. Why are they doing it? because of our asset quality, the net asset value is $22.30 a share. And one of the best balance sheets out there, one of the best free cash flow yields out there. So we have the whole indicia, and the real key is asset quality. As Jared showed you, we have two of the top 4 plays in the country, shallow, conventional, low-cost plays. Our plays work at $50 oil. They look ridiculous at $78 oil or whatever it's at today. So that's our story. Our goal is be the top performer again this year, and I think we got a good shot at doing it. We'd open it up just for any questions people might have.
Okie dokie. I'm going to start with, what do you think the biggest contributing factor to your increase in PDP NAV was?
Great question, actually. It's probably the best result I've ever had, even better than we had in any one year during when we found the Bakken play at Crescent Point. So to have your PDP NAV, as you get bigger, 5,000, if you're 5,000 barrels a day and you have a big discovery, it can really move the needle. As you get to 10, 15, 20, 25,000 barrels a day, have your PDP NAV go up 107% in 1 year is unbelievable. So the oil price definitely helped. The price deck was $70 WTI last year, and it's 80, just over 80 this year. But with power costs going up dramatically, about a third to half of that upside was taken away because power costs went up in the engineering report. So it helped. But I would say our two big movers, the three movers, would be the Steelman discovery in Southeast Saskatchewan. We spent $9 million on a crown sale there. That's those big wells Jared was showing you. And 9 months later, 10 months later in our engineering report, it's over $100 million of NPV. So we turned 9 million into 101 million in 9 months. But equally important as well was the Interplus transaction. We paid $198 million, and we've owned it for 11 weeks. It closed in December. Today, it has an NPV for the PDP of 287 million. So we paid 198, and the PDP 10 weeks later, 11 weeks later is 287 million. So those are the main factors.
Pretty good return on investment.
Crazy.
And one other thing in that note, I noticed your recovery factor went up by almost 1% on your Sproul report. Is that correct?
That's perfect, right? Because that's what Jared and I have been showing you for 2 years. The logical moving over of the total proved and the P plus P over into PDP, and it goes at about 1% per year. And that's a good thing. That just shows you that our big oil in place pools, that's why we delivered one of the best PDP increases per share of any oil company in Canada is the asset quality. And it goes like 1%, as Jared said, is equal to our entire enterprise value, undiscounted cash. It's so valuable. 1% change on 3 billion is 30 million barrels.
Yeah, well, no, that it's significant, and now we're starting to see that come through. So
exactly.
I was pleased to see that. A lot of your peer group is trading at a significant premium to their PDP NAVs, and you're at 1.2 times. What do you think it's going to take for the market to actually wake up and start giving you to narrow that valuation gap, given again that you're at 3 times EBITDA, your free cash flow yield 24%?
Yeah, I love where we're trading because you see today we put out the good quarter. We put out the best PDP NAV growth per share in the country. And the market, I haven't seen it, but we're up at 1.6%, leading the entire country in stock price today. So it just proves the market is efficient, but you have to go execute and put out the good quarters like we just did. And as long as we keep delivering, I think you'll see it. One thing I would caution you on, and any investors listening to this, is gas companies are crowing about their gas net asset values and their growth. Great. But gas price decks have gone from GLJ price deck is over $6 an MCF for gas companies. Well, gas strip is about $240, $250 a share, or $250 an MCF. So I'm saying to you, be careful of companies that are gas companies. When you look at the oil, our net asset value is about $82 WTI. I think it is 82, 83. So all I'm saying is we're within $5 of that. We're within a spit of that right now. So I just bring it up because our NAV is for oil. We're 87% oil.
And as you talk about kind of essentially catalysts here for market recognition, it's also worth repeating that there's only a few days of Enerplus in our Q4 numbers. So we haven't even put out a quarter here full with Enerplus. So you can expect that in early May when we come out with our Q1s, you'll see that inaugural quarter. So that should be hopefully another positive, another lift for the search story.
Your 25,000 BOEs a day, do you think we could see a little growth uptick on that, or are you just going to stick to the 25 and your pay down debt, etc.?
Yeah, with us trading so far below our net asset value, if it's $22.30 a share, I think what we're going to do is just keep our production flat, increase our dividend probably in Q4 as we hit the second phase debt target and pay debt down. As we hit our it'd probably be in Q2, we hit our third debt target here. Remember, when we do that, when we hit the second one in Q4 this year, we could increase the dividend 100%. We wouldn't. I think Birchcliff probably regrets pumping theirs 900% now, but we would probably increase the dividend, I'll say 25 to 30% or something like that. Plus keep paying the debt down, plus start the share buyback program. And then we expect to hit in 1 year, in just 1 year, we expect to not hit the phase 2. We expect to hit the phase 2 and the phase 3. Well, that means we could increase the dividend 200%. So it just shows you how much free cash we have. We're just being disciplined. We'll give a nice chunk to the shareholders on dividend, have the share buyback, but keep chunking it onto the debt. And we're going to reach a terminal debt target in Q2 of next year, so just over a year from now.
So that's one, it leads to another question here from the audience. As you become and continue to be the must-own in the sector, which I think you will be, given your leverage to oil, you have the highest leverage to oil of your peer group from what I can see, and I don't expect your production mix to change. Do you have any prospective institutional holders lamenting late entry, but also having to pay a premium to the market to assemble a meaningful position? Well, I don't really think you're trading a premium to the market, so I disagree with that. For their fund, given the daily trading volumes, could be a bit of a hindrance. Moreover, more generalist funds and newer energy funds knocking at your door.
Yeah, we are definitely seeing a significant increase in institutional interest. We were recently out in Toronto for a large energy conference. At full day, had to add more time on either side of that. So we are seeing significant interest there. As you think about the equity raise, we had massive interest institutionally in the equity raise that we did in concert with the Enerplus deal. Went out to raise $40 million, massively oversubscribed, came in with about $280 million in demand. We upsized it to a total of $80 million. We had over 30 top institutions come in and take a significant component of that equity raise down, and we then did see them in the market following on buying. So we are seeing increased interest and demand in buying from many of the top institutions.
And I think most people are fairly constructive on oil. We've taken a little bit of a breather going into the end of last year and early this year. And, typically January is not the greatest month for energy stocks. But of those people that bought on your deal, have you seen some rollover, or they just continue to buy as you've come down a little bit more?
Yeah, as far as we've been able to tell from the public disclosure and discussions with those buyers, they've been in the market buying and filling in those positions here when the opportunity presents itself.
Sorry, I had such a difficult time asking that question. It wouldn't come out. Will Surge drill 35-leg multilateral like those spider wells that Lycos is doing in the Sparky?
Yeah, so I think a differentiator we're trying to make there is, there's becoming a lot of interest in the medium and then ultimately the heavy window of the Sparky, from little guys like Lycos up to the biggest producer in Canada in CNRL. So what folks are often asking us about is the Fishbone design, where they're going in and drawing, just think of a fish main line with a bunch of spurs or bones off it. That isn't something we're really contemplating at Surge, and that's again back to the company and the way we've designed it. It's down to rock It's down to rock quality. We've got great permeability and great competent rock. The Sparky is sitting at about 700 meters depth. So we have great competent rock. We don't have sand issues. So really those folks are drilling those fishbone wells to deal with many of those bones plugging up with sand. We don't have that problem. But what we are doing here is attacking this halo play. You can see it in light gray, call it the 18 to 20 degree oil window, the heavier end of the medium spectrum. We're going in there and drilling, we've drilled 6-7 leg wells in here. We are looking at tightening the interleg spacing and going to potentially 10 or 12 leg wells in here and further increasing the productivity. So this is definitely an area of focus for us and something we'll be attacking with that open hole multi-leg technology.
So that leads, yeah. So are you still employing the multi-leg horizontals in for your new CapEx? If yes, as a follow-up, can you talk about anything we've learned about longer term decline rates in these wells?
Yeah, so I think I answered a good component of that, but yeah, definitely something we're continuing to look at and is seeing a larger and larger piece of the budget. But we do want to continue to focus using the fracked single legs in the light and medium window. Those wells are fantastic and they really are amenable to water flood. We've had over 1 million barrels of water flood bookings in just a couple pools, booking wells that are usually 120,000 barrels of EUR on primary, upwards of 400,000 barrels with an injector on either side in multiple Sparky pools this year. So the horizontal multi-frac water flood is working great in the Sparky. So we're not going to pivot 100% to just doing the multi-legs. We're going to be very tactical in where we apply multi-legs versus the single leg fracs to maximize the economics for our shareholders. So I think that hopefully answers most of that question.
I think it does. Yeah. And just one question on the Sparky Reservoir. I mean, obviously it's water floodable and you haven't water flooded the majority of it, but is it a good candidate for tertiary recovery as well?
Yeah, I'd say there's probably potential there. Again, we are in the enviable position where, we're still drilling this primary and starting water flood. But I'm sure in the decades to come, things like CO2 flooding that's working great in Saskatchewan, other places, maybe candidates here, polymer floods, things like that. But we've got so much runway in front of us on primary and water flood that tertiary recovery is
down. Way out there. Yeah, you're not even thinking about it.
Yeah, this isn't something that's been picked clean and needs tertiary recovery. There's so much to do here.
Yeah. Okay, so production guidance for we just kind of answered that already. People are asking if Nuttall's still holding. I don't know if that's something you can comment on or not.
Yeah, as far as we're aware, he is, but yeah, not something we could comment on otherwise.
Okay. What do you expect your royalty rate and DD&A rate to be this year?
Royalty rate should be about 18.5%. Our DD&A expense should be about $18 to $19 per barrel.
Okay, and hedging program, what does that look like for this year?
Yeah, so it's not in this deck, it's on our website. Take a look at the back appendices there for some more detail. But at a high level, what we've done is taken some of those wide collars we had, particularly in Q2 and Q3 of this year. We had $65 US WTI floors and upwards of $110 to $130 ceilings. For pennies, we took out the ceilings. So for Q2 and Q3, we really just own $65 puts. So you've got a lot of option value, all the upside there for WTI in the next coming quarters.
Okay, on M&A, given the choppy market and given that the outlook for gas is not good, really, I don't think for at least another year, for AECO anyway. A lot of your peers are a little bit gassier and we'll see their production, their cash flow numbers come down. Do you expect to see more assets for sale? And are you seeing more for sale right now? And you guys have always been pretty astute to picking up things when other people are struggling a little. So what does the atmosphere look like right now?
We don't see that many corporates that meet our asset criteria. As you saw, and Jesse, we chase those Enerplus assets for 7 years. They're beautiful long life water floods that fit us perfectly. So 7 years later, we finally got them. We don't see many other companies with assets of that quality. So I think what we'll do is go look in particular for companies that are stressed financially, that did takeovers for cash and no shares. and go in and look to pluck elite reservoirs. So I think there's a better chance for us to find good reservoirs in our core areas rather than corporates or private cos. So
Yes.
right now, yeah, look for us to just go out and grind out the next 2-3 quarters, hit our phase 2 debt target. And if we do see an asset that pops up, particularly somebody who's taken on some debt on a deal or something, we would go in probably asset specific and try and pluck that reservoir out of them.
Staying in your core areas.
Staying cored up, yeah.
Yeah. What do you estimate natural gas prices and NGL prices will be this year, given you don't produce many of them? I don't know if you have an answer. I mean, what I've heard for AECO prices could get as low as 0 for the summer. But what are you seeing on NGL prices?
Yeah, I think NGL prices have generally been under pressure. You know, they only make up a tiny fraction of our production. So condensate continues to be strong. The rest of the NGLs, pentane, butane, propane, seem to be under pressure as well, much like gas. We've seen a lot of these guys drilling up north for the oil, stripping the condi and the oil, and that's put a lot of pressure on gas and some of the associated liquids.
Yeah. I think that's one of the biggest problems. And no one seems to be slowing down their gas drilling particularly. I mean, that's... but I do understand that there's going to be a lot of shut-ins this summer and reaching full storage by in Alberta anyway. So, okay, at what price can you sustain your dividend? I'm assuming down to about $60. Can you still sustain?
Yeah, somewhere in the 60s is a good number. Depends on, FX, gas price, all the other inputs, right? But depending on where the dollar continues to go, and gas prices and differentials have been a huge help for us here. They blew out, the Canadian oil differentials blew out, came right back in, and they continue to tighten. So that'll be another tailwind that helps drop that number down. But yeah, something in the mid to low 60s is a good estimate. And that's for an annual, that's for 12 months, not 1 day or 2 weeks.
Okay, and I would think with the SPR refill, et cetera, that should continue to narrow differentials even more.
Yeah, exactly. The folks that manage the SPR in the States came out and said they want to be buying up to 60 million barrels, most of that heavy and mediums, which will play well into WCS. And that combined with TMX, the new pipeline coming on up here that goes over to the West Coast, giving us access to Asian markets. There's a lot of reasons to be bullish on that WCS differential, and that'll further drop that break even.
Just again, for those people who are concerned or just on a blowdown scenario, when does the Frobisher become uneconomic to drill as well as your Sparky?
Frobisher play is probably the best play in North America over the last 75 years, and it's based on the high flush rates, the quick payouts, and the low cost drilling. You don't need to frack them. We've had some of the wells that are still at 1.4 in this, but we've actually seen a bit of a softening of the inflation. I think they'll gravitate back to 1.2 million all in, and payout, as Jared said, some of our wells are paying out in 2-3 months. So what shocked me just the other day at our board meeting 2 days ago to approve the Q4, we now have over 200 Frobisher locations. Well, we're only drilling 30 wells in Saskatchewan all year this year. So we have Frobisher, Mydale, we have Lida, Kisby. So all I'm saying is I think it's been one of the best plays in all of North America because of the low cost drilling, the flush rates, and there's an active aquifer. So it's like a built-in water flood pushing the light oil out of you. Highest netbacks in Canada. So yeah, it's an amazing play. Yeah, I think when you ask about that, I mean, this chart here is essentially the inverse of that question. When we think about COVID and the depths of COVID, when oil was 30 and 40 WTI, we looked at rig counts and where were guys drilling, and they were drilling in pretty much 3 or 4 places. They were drilling in Sparky, they were drilling in Southeast Sask, and then they were drilling the Clearwater. Those are the plays. The top plays are the only plays that work at those low prices, and 75% of our inventory is in those plays.
Okay. Yeah, I thought your break even would be fairly low. Safety and health. You guys haven't had any major accidents that I know of. No, we have one of the lower TRIFs, total recordable injury frequency, one of the lowest scores
in the industry. We target top decile numbers there. It is one of the metrics that influences management compensation. So we are highly focused on maintaining zero incidents where we can, and have nothing of note.
We would even do it if we weren't comped a lot for it, Jess.
Of course, it goes without saying. Good point, Paul. Sorry.
Yeah, you don't have to be paid to keep people alive, I guess.
Exactly.
No, it's just to highlight the importance corporately from the board down. We are focused on it.
Okay. Any land sales coming up that you might be interested in?
Yes, we have sales in Sparky, Southeast Sask. Pending, will be killed by our land VP if we talk about it. Margaret would kill us, but yes, we just like we had the Frobisher sale in about 11 months ago, where we drilled the best wells. We added 40 beautiful Frobisher lokes there. We have some more in both our two key core areas.
Okay, well, we're looking forward to hearing the results of those sales. When will we know?
On the next couple of months, and we've already acquired the next Frobisher, we think lookalike to the Steelman sale. So those wells will be drilled right out of the chute in Q3, programmed sometime in early July. So that has upwards of 25 more locations, and we have vertical Frobisher wells up dip that have done over 150,000 barrels. So we're extremely excited about that new Frobisher play. So am I. You guys have done a phenomenal job. Considering when you bought it, you really didn't think it was much, right? Like you thought it was standard, kind of good. Yeah, I got to admit that the Astra deal and Fire Sky deal, like for us to be 8,000 barrels now is we're over 8,000 this week in our weekly production report. A year and a half ago, we were 0 in Saskatchewan, and to go get dominant high quality assets like the Interplus assets to backfill the drilling has been exciting. And Mount Bastion drilling program? Mount Bastion, those assets, what do we think of those? Mm-hmm. Yeah, those are, again, to go to Jared's numbers that Chardy shows you, I love that asset. If I got spun out in that today, it's a classic. It's 600 million barrels of oil in place, less than a 6% recovery factor. The wells are coming on, still have 40-45% oil cut to them. And we have wells offsetting injectors. So we've started to go in and do injectors. Now, we haven't drilled it much because the wells cost about 3.5 million, 3.8 million. And we will be drilling it. We have 120 lopes there. We love it. We've got wells offsetting injectors that have done 600,000 barrels of light oil, and they're flat at 65 barrels a day. Phenomenal asset. We would say that we would drill it in a higher commodity price environment like we're seeing now. So above 75. So look for us to add a few of those wells either later this year or next year into our budget. They're phenomenal wells that pay out in less than a year and a half at these prices. We like it. But you have things obviously with that or have better economics right now than that. So Shaunavon might be some. It's down to 1,200 barrels a day, pretty flat. We like it, but that might be one we sell. Valhalla, but Greater Son is about 3,000 barrels of beautiful long life water flooded light oil. Now the OPEX creeps up over time as you quit drilling it. So to go up there and drill a 10-well program would be huge for Surge, and that's probably something we'd look at next year. Can you comment on current, we talked about, well, he's asking about your current hedge portfolio moving into 2023 from Q4, but you kind of already answered that, so pretty much. Yeah, take a look at the corporate presentation on the website in the back. There's a lot of great detail there as well. Okay, and then I think that's kind of it for the questions. Great questions. Thanks for your time, guys. Really appreciate it. And look for us to put out another strong quarter in Q1 here in 9 weeks. So I think we report in May. Yeah, May 3rd. So look for another big quarter. And just frankly, our focus is the next 2 to 3 months. debt pay down, hit the next debt target in probably early Q4 and bump the dividend. We could bump it 100%, but we'd probably do something like 25, 30% and just keep chunking it onto the debt, start our share buyback program as well. Just have it ready, and times when the market's weak, jump in and buy some stock.
Well, you've done a fantastic job. Thank you for
Thanks.
Thanks, everybody.
And did I miss anything, do you think, from my questions?
I think it was good.
Okay, then we're good. Thank you, guys. Appreciate your time as always, and look forward to hearing more after.
Sounds good. Thank you.
Take
care.
Thanks.